Hey there, fellow investors. Have you ever wondered how to maximize your returns while keeping risk to a minimum? What if I told you there's a strategy that could help you achieve just that? Stick around, because today we're diving into practical ways to boost your investment game without losing sleep at night. Now imagine this. You've saved up a nice little nest egg and you're ready to invest. But here's the kicker. You want your money to grow, but you also don't want to see it disappear overnight. So, how do you strike that perfect balance between risk and reward? Let's break it down. First up, understand your risk tolerance. This is your personal comfort level with the possibility of losing money. Are you someone who can handle market fluctuations, or do you prefer a more stable approach? Think of it like this. Investing in stocks is like riding a roller coaster, thrilling but unpredictable. On the other hand, bonds are like a calm boat ride. Steady, but you won't get the adrenaline rush. Take some time to assess what feels right for you. Next, let's talk about time horizon. How long do you plan to invest? If you're looking at a long-term goal, say retirement in 30 years, you can afford to take on a bit more risk because you have time to ride out the ups and downs of the market. Conversely, if you need the money in just a few years, a conservative approach might be your best bet. Picture your investments like a tree. The longer you let it grow, the bigger the fruits you can harvest. Now, here's where it gets exciting. Diversification. This is your secret weapon for minimizing risk while maximizing returns. Think of it like a balanced diet. Don't put all your eggs in one basket. Spread your investments across different asset classes like stocks, bonds, and real estate. By doing this, you're less likely to feel the sting of a market dip because some investments might do well while others don't. Let's bring in a relatable example. Imagine you invested in a tech stock that skyrocketed last year. Awesome, right? But what if that same stock crashes this year due to market volatility? If that was your only investment, you'd be sweating bullets. However, if you also had bonds and maybe some real estate investment trust REITs in your portfolio, you'd have a cushion to soften the blow. It's all about balancing the highs and lows. Speaking of real estate, have you considered ETFs? Exchange-traded funds are a fantastic way to get broad market exposure without having to pick individual stocks. They're like a buffet for investors, allowing you to sample a bit of everything. This way, you can capitalize on the overall market's performance while keeping your risk in check. Now, let's not forget about dollar cost averaging. This technique is like setting up a consistent routine at the gym. By regularly investing a fixed amount of money, say monthly, you buy more shares when prices are low and fewer when they're high. Over time, this can lower your average cost per share and help mitigate the impact of market volatility. So, to recap, here are our key takeaways for maximizing returns with minimal risk. 1. Know your risk tolerance. Are you a thrill seeker or a cautious investor? 2. Define your time horizon. Long-term goals allow for more risk. 3. Diversify your portfolio. Don't put all your money in one place. 4. Consider ETFs for broad exposure without the hassle. 5. Use dollar cost averaging to ride the market waves more smoothly. And there you have it. By following these strategies, you can work toward growing your investments while keeping that pesky risk at bay. Now, I want to hear from you. Are you already using any of these strategies? Or are you team, let it ride on risky investments? Drop a comment below and let us know your thoughts. And don't forget, next time we're diving into an asset class you might not be paying attention to that could be a game changer for your portfolio. You won't want to miss it. Until then, happy investing